Thanks, Graham. Yeah, so I will talk a little bit about how we'd like to see the economy run later on in the day. But for the minute, I want to talk about how the current monetary system runs. And in particular, I want to talk about where money comes from. So this should be quite a simple question. The obvious answer is that money is printed, and sure enough, a small amount of money is printed. Just to give you an idea, though, only about 3% of euros exist as cash and coins. The other 97% is electronic money, and it consists of the numbers in our bank account. So that's really what money looks like today. It's the numbers in your bank account. Now, it's this 97% that we're trying to educate about, because not everybody's completely familiar with exactly how it's created, and even fewer people seem to understand why there's less of it during a recession. So put as simply as possible, digital money comes from bank loans, because if you get a loan from a bank, it's not actually a loan of pre-existent money. It doesn't come from other people's deposits or from the bank's reserves or anything like that. Banks create the money they lend quite simply by typing a new bank balance into your account when you organize a loan. Now, as a result, every electronic euro has an even higher debt because banks only create the amount of the loan and they expect the amount plus interest back. So they create more debt than they do money with each loan transaction. Now, not everybody believes me when I say that, but I have a couple of quotes from central bankers here which should prove the point. This comes from Paul Tucker at the Bank of England. Banks extend credit by simply increasing the borrowing customer's current account. When banks make loans, they create additional deposits for those that have borrowed. Each and every time a bank makes a loan, new bank credit is created, new deposits, brand new money. Money is primarily created through the extension of bank credit. The commercial banks can create money themselves. And finally, from Mervyn King at the Bank of England, when banks extend loans to their customers, they create money by crediting their customers' accounts. So it really is as straightforward as that. You organize a loan from a bank, you get approval, and they type money into your account. Now, this makes sense from an accountancy point of view as well, and indeed nothing else does, because your bank balance is a liability of the banks. So when you get a loan, it goes up. So too does the bank's liabilities. They make a credit entry to your account. Your debt to the bank is its asset, and it goes up. So they make a debit entry to the asset side of their balance sheet. And that's it. Two accounting entries go up, and that's how money is created these days. Now, if anybody thinks that banks do lend existing money, just ask yourself, what account would they credit the money from, and what would be the corresponding debit entry? Now, I want to talk about the money multiplier model of banking. This is the nearest that most economics textbooks comes to explaining how money is created. And the story unfolds as follows. So imagine the central bank prints an extra €100 note. It makes its way into circulation. Eventually, it will be deposited with a bank, and they'll write down new bank balance €100 for that customer. Now, someone might borrow perhaps €90 of it, so the bank will keep perhaps €10 aside, lend out the 90. It'll change hands, and eventually it'll be deposited with a bank, and that bank will write down new bank balance €90. So bear in mind, there's only €100 cash added to the amount of money in circulation, but it's now two bank balances. One reads 100, one reads 90, and the actual €100 note as well could be used as money. And it doesn't end there. The bank might keep some of the €90 aside. It might lend out 81, and eventually it'll be deposited with a bank, and they will write down new bank balance €81. And this process continues. So there's only €100 cash in the world, but several bank balances. One reads 100, one reads 90, one reads 81, and so on. And this is called the multiplier effect, and this is the money multiplier model of banking. Now, it's really, really popular, but it doesn't actually apply for a number of different reasons, the most obvious of which is that this would only actually apply if banks processed every loan in cash form. So if we go back a few steps, the central bank might print a €100 note, someone will deposit that with a bank, the bank will write down new balance €100. If someone walks into the bank to borrow €90 and they leave with a higher bank balance and not the cash, then the model just immediately breaks down. All right, so this model of banking just doesn't apply anymore. But economists tend to believe this because they learn it in university. There's no reason to really question it. And as a result, it pops up all over the place. I have several different examples here. I just picked out 3. So this one comes from an economic think tank called Redefine. And from their own website, they say they advise several governments, international agencies, and non-governmental bodies on a number of key policy themes. And in 2010, they wrote a paper called How to Design a Good Banking System. And in that paper, they explain what banks do. And they say, while individual banks cannot create credit, the banking system as a whole does exactly that. And above it is the description of the money multiplier there. $100 gets deposited, $10 gets kept aside, 90 is lent out, and so on. So these guys advise several governments on a number of key policy themes, and they just don't have a good handle on the banking system. This comes from the Central Bank of Ireland. They're saying credit institutions' total domestic deposit liabilities traditionally have been the main funding source for mortgage supply, or in other words, mortgages are funded from other people's deposits. Now, that's just not the case. If it were the case, a bank could never actually lend out more than it had on deposit. And when that happened, the central bank saying much of the surplus funding was sourced from the United States. So again, there's no acknowledgement here that banks can just create the money they lend. All the while, economists seem to think that, no, that just can't happen. Banks have to fund the money from somewhere. No acknowledgement that they're creating it. This might be the worst one. This comes from the BAL Committee on Banking Supervision at the Bank for International Settlements. So these are guys who wrote the BAL Accords, the latest version is the BAL Accords 3. And you'd imagine they would have a really good handle on the banking system. And in the introduction to their publication on the BAL Accords 3, they say, banks are at the center of the credit intermediation process between savers and investors. So again, they seem to think the banks, first of all, take money in from savers, keep some aside, and then lend out the rest to investors. But that's just not the case. Now, where does money go during a recession, or why is there less money during a recession? This is quite a little known fact, but when you repay a loan to a bank, the money no longer exists. So economists will tell you this first reason, that money is saved during a recession. And sure enough, if everybody saves a little bit of money, it can feel like there's less money in circulation. But a far bigger reason is that money is deleted as loan repayments are made. Now, again, this makes total sense from an accountancy point of view, because if you repay your mortgage or any loan, you leave with a lower bank balance and a lower debt to the bank. So the bank will debit your account by that amount. They'll credit their debtor's account. So 2 accounting entries go down. You no longer owe that money. The money no longer exists. And that's why there's less money during a recession. A new loan creates new money. A loan repayment destroys money. And if loan repayments are greater than new loans, then the amount of money in circulation can decrease. So that's why there's less money during a recession. Now, economists don't seem to have a good handle on this in particular, because at the minute they're all advocating debt reduction. And if we reduce our debts, the money no longer exists, and that's a real problem for the economy. You know, money is the lifeblood of the economy. It's the medium of exchange that we use. And if there's less of it, we just can't trade as easily as we used to. Now, I have a couple of quotes on this from some central bankers. Every loan, overdraft, or bank purchase creates a deposit, and every repayment of a loan, overdraft, or bank sale destroys a deposit. If all bank loans were paid, no one would have a bank deposit, and there would not be a dollar of currency or coin in circulation. This comes from Peter Pratt at the ECB. He's describing inside money, which is the type of money that banks create, and he's saying inside money instead is named this way because it is backed by private credit. It would cancel out if all claims held by banks on private creditors were to be settled. So it is one form of money that is created and can be destroyed within the private economy. And finally, from Mervyn King again, he's saying what the banking system has been doing is destroying money. And he was referring to loan repayments when he said that. So in a nutshell, that's how the economy operates. Money comes from bank loans. It always has an even higher debt, and if we reduce our debts, the amount of money in the economy goes down. Now, we have a couple of guides on this on our website at www.sensiblemoney.ie. So on the left there is a guide how banks create and destroy money. And this is kind of our layperson's guide. So it explains the process quite simply. It explains not only what I've described there, but it explains how central banks create the type of money that they deal with. Central bank money explains what happens if you transfer money from here to some bank account in Spain or whatever. And if you're already familiar with accountancy, you could jump straight into our publication on the right there, which is How Money is Created and Destroyed, a guide to the Eurozone monetary system. And that just explains exactly again, but it assumes a little bit of knowledge, and it shows actual balance sheets as opposed to the simplified version on the left there. So if anybody wants to know a bit more about how money is created, these are two pretty good guides for the Eurozone. If you're not particularly into the reading end of things, our sister organisation in the UK, Positive Money, positivemoney.org is their website. They have a fantastic video series, really well paced. It's called Banking 101, and it explains that process pretty well. Yes?
Can you put up in large print the URL of the website?
Not straight away. It's www.sensiblemoney.ie. I can flick through it. Yeah, sensiblemoney.ie. I can flick through it just at the very end of this talk. No worries. So that's quite a simple process, really. You go into a bank, you organise a loan, they type money into your account, you repay a loan, they delete money from your account. And it's all very simple, really. But there are huge consequences to this quite simple process. And this is really what we're here to discuss today. So I'll just quickly go through some of the consequences. Ultimately, I think it's a system unfit for purpose. We can't achieve full employment all the time under this system. We also have an incredible productive capacity, but we can't enjoy the fruits of our own labour, essentially. The debt crisis, I believe, was caused by this, creating every euro with an even higher debt, and then having an over-indebted economy is no surprise. Unaffordable housing and the mortgage arrears problem. Unaffordable housing, first of all, when banks are deciding what project to create money for, they're incentivized to create a money for a project involving a real-world asset. So that's why they're not necessarily too keen on putting money into projects that might involve an increase in GDP, for example. If they can get money into a project involving a real-world asset, that's really what they'd like to do. The mortgage arrears problem then. It's just not possible for all loans to be repaid under this system. As soon as we stop taking out more loans than we repaid, the money supply goes down, and this discourages more people from taking out more bank loans and so on. So the money supply continues to go down. And bear in mind, there's a certain amount of money in circulation. All of it plus more is owed back to the banks. Now, do want to be careful here. It's not quite as straightforward as the principal plus interest is greater than the principal. It gets complicated because banks only delete the principal of the loan upon repayment. They record any interest you repay them as profit, and ultimately they pay their staff or whatever. That money ends up back in circulation. But I think regardless of any theory about how it might be possible for all loans to be repaid, the extent of the mortgage arrears problem and the arrears problem with SMEs as well just shows that it's just not possible under this system for all loans to go according to plan. Higher taxes, so we're going to learn a bit more about that later, but when the central bank prints money, again, the accountancy is a bit complicated, but ultimately it becomes a source of non-tax revenue for the Department of Finance. And back in the 60s, for example, when we dealt with so much more cash, every year the Department of Finance enjoyed this quite significant source of non-tax revenue, but it's not a significant source today, and we pay higher taxes as a result. Unemployment, we're going to learn about some of the consequences of that later as well, but ultimately this system just can't achieve full employment all the time. We have work to be done, we have people willing to work. It's often just a lack of this medium of exchange to bring it all together. That's the problem. And environmental damage, so this is quite a complicated area. But a couple of things on it. Governments forget about the environment when they're dealing with a financial crisis. So that's a big one. Under the debt-based system, every country would like to become a net exporter. So there's huge drive towards exporting more, producing more, and so on, and then selling it further and further away. Also, this system only really works well if it expands, all right? If the money supply expands, we can pay last year's loan off reasonably well and so on. But we live in a finite planet, of course. We just can't expand GDP forever. So this has environmental consequences as well. And many of our social problems then are down to a lack of this medium of exchange or the extreme inequality that this system produces. Now I want to talk a little bit about how unique this recession might be. So this is a graph of the money supply in the UK actually, but it is similar for the Eurozone. And it goes back to the 60s, and you can't quite make it out from this graph, but back in the 60s, about 20% of the money supply existed as cash and coins. That red line was 20% of the green line. Now that's a totally different economy to do business in than we have today, because the 20% is created without a corresponding debt. It's ultimately becomes a source of non-tax revenue for the Department of Finance of that country, and it acts as quite a buffer, quite the debt-free buffer to the 80% of bank-created money. So that system can work reasonably well. Now, almost overnight, when we got computers and we were able to bypass the checkbook, we were able to use our bank accounts as money more efficiently. And we were able to create money that little bit easier as well. So as a result, the electronic money supply just shot off when we got computers. And almost overnight, the amount of cash and coins in the economy went from 20% down to 3%. And that is a totally different economy to do business in. That's the one we're in today, where basically every euro has an even higher debt. And it's just not possible for businesses to run without the hassle of defaulting and foreclosures and so on. So it's a totally different economy to do business in. Now, we have had this system for decades, and I guess you could say it's worked reasonably well for the last 4 decades. And we think the reason is because the money supply has doubled about every decade, and you can see that from this graph. Now, that is a huge expansion of the money supply. You know, for something to quadruple over the course of 20 years, makes a huge difference to the economy. If you get out a loan, and over the course of the next 20 years, the money supply around you quadruples, your loan can feel quite manageable. So that's why we haven't had huge amounts of defaults in recent decades. Now, we think that this is quite a unique recession because extrapolating that graph there, we just don't think it's feasible at all that we can double the money supply every 10 years for the foreseeable future. And it seems that sort of a rate of expansion of the money supply, it's what's needed to keep this system running relatively smoothly. So we think this is just the end of the useful life, anyway, of this particular system. One other thing just to note from the graph is the relationship between notes and coins plus central bank reserves and commercial bank created money. So you can see the red line is almost flat for decades, and yet the green line grows exponentially. Now, economists will tell you that they should be in proportion to each other because, first of all, the central bank will create the red line, and from there, the banks will create a multiple of that under this multiplier model. Now, of course, that's just not the case. If anything, it works the other way around. Banks create the green line first, and then the central bank is under pressure to create reserves to keep the reserve ratio correct. And one other little thing, just at the very end there, you can see with quantitative easing in the UK, they pumped a lot of central bank money into the system. And yet, you can see the green line do a little dip here. So there's no real correlation between these two. One other little thing just to wrap up is just why would banks need depositors or savers is a common enough question. And banks, of course, don't really need depositors because they don't lend out depositors money. Of course, they're not actually that interested in handling cash these days, so they really don't want people depositing money with them, cash with them anyway. Now, they do need customers, and they need people to bank with them and so on. And they actually create most of their depositors whenever someone organizes a loan off them. Now, why would they pay interest on deposits? Well, that's just a historical reason, really. Once upon a time, banks did actually lend out other people's cash. You know, they didn't just type money into people's accounts. They were actually lending out other people's deposits. And it's just a hangover from that, essentially, that we still receive some interest sometimes on deposits. Now, of course, it's less and less, and ultimately we are charged for our bank accounts when you subtract whatever little bit of interest you receive from all the bank charges and so on. Ultimately, we are charged. Now, why would banks need savers? Now, they do pay reasonable amount of interest rates to savers. And the reason is that if a bank creates a lot of money by typing money into people's accounts, it has a series of really liquid liabilities. At any moment, you could transfer that money to someone else's account. And at that stage, that bank will be under pressure to transfer a lot of central bank reserve money to another bank. So if they've created too much money, at that point, they're under pressure to get people to open up savings accounts with them. Because if you get a savings account with a bank, your money is still a liability of the banks, but it's a less liquid one. They know that you can't transfer that money anytime quickly. So in that sense, our monetary system actually works the reverse of how most economists think it works. Most economists would think that, first of all, a bank needs savers, and from there, they're in a position to lend out money. Actually, they're in a position to lend out money, and once they do that, they're under pressure to get people to save that money so that they don't have to transfer any central bank reserve money, and that puts them in a better position to create even more money and so on. Okay, that's it for the moment. I'll be back later to talk about how we would like to see the economy run, but I'll just open the floor to questions. Just one last little slide. This is just the M3 money supply in the Eurozone, and again, we can just see this doubling of the money supply every decade. I just chose this one because it demonstrates the relationship or lack of relationship between central bank reserve money and the M3 money supply. All right. Okay, so any questions? Thank you.